please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Indianomics. The topic today is the worsening Indian macros. Crude prices are now threatening to remain well over $70. Separately, the trade deficit, even at lower crude prices, have shot up. In March, it was nearly $14 billion. Thus, even in a year, that is FY18, when crude prices averaged between $50 and $60, the current account deficit has likely been 2% of GDP. With crude likely to average over $70 in FY19, will the current account deficit move closer to 3%, which is a danger mark? Separately, the fiscal deficit could also rise partly due to crude prices and partly due to election year largesse, especially on the MSP front. Bond yields have already surged and the rupee has fallen, reflecting the worsening of these macros. So the question we are asking today is, have our macros reached a tipping point? Joining us now is Ashima Goyal, member of the Prime Minister's Economic Advisory Council, Sajid Chinoy, the economist from JP Morgan, and Neeraj Gambhir, Managing Director at Nomura's Fixed Income Unit. Gentlemen and lady, welcome to the show. Well, first up, Sajid, let me start with you. You've just put out a note indicating that the trade deficit for March, if seasonally adjusted, would actually have been well over $15 billion. Now, your current account deficit, even when crude prices were lower, you say would be 2%. So are we in danger of getting to probably 3% current account deficit in the current year?
I think we should recognize to start with that when oil prices move up so rapidly as they have in the last 6 months, this is an adverse terms of trade shock for India as a large oil importer, and more fundamentally, this makes the growth inflation trade-off much worse. So that's a more fundamental problem. On the external front, we've had a view for a very long time. 6 months ago, we said that in a world where growth was very strong, India's exports underperformed. And last year, despite growth slowing, imports were very strong. So despite GDP growth slowing in 2017-18, the current account deficit is on course to tripling from $15 billion last year to almost $50 billion in 17-18. Now, if on that base you overlay a crude estimate of about $70 a barrel for 18-19, the current account deficit is about $75 billion or about 2.7% of GDP. So not nearly at 3, but above the 2.5% considered sustainable. And this is a view we've had for the last 3 months. Let me say a couple of points. I think the last 4 months you're already seeing that. On a seasonally adjusted basis, the monthly trade deficit has averaged $15.5 billion a month since December, which is an annualized current account of $75 billion. But I think the area of concern for me slightly is that if you look at the mix of capital flows, they've become a little less stable. We get carried away by large balance of payment surpluses, but in the first 3 quarters of this fiscal year, FDI has been 25% below last year, and a lot of the current account is being financed by interest-sensitive flows. Now, next year, with global rates expected to go up and Indian rates kind of having already peaked, the interest rate differential goes against India. So how confident can we be of attracting these flows to finance a much larger current account? But let me end by saying that I don't think there's reason to panic. I think we need to be in a heightened state of vigilance because these things can move very quickly. But we don't need to panic because what's different from 2013 is the RBI is sitting on a war chest of FX reserves, $450 billion. So no real need for panic.
Okay. Well, I'm going to pose the same question to Ashima as well. Ashima, Sajid thinks that there are 2 major dangers, that trade deficit is widening and it could widen even further because of crude, and 2, the quality of our capital flows is a bit questionable. Yet, not time to panic. What would your take be? If crude were to go to $70, it is not just a current account deficit problem. It will also reflect as a fiscal deficit problem. But first, let me take current account deficit. Do you think we are likely to hit 2.7 or even worse in the current year?
I think we should not extrapolate from the current situation because markets, there are possibilities of correction. one reason for slow export growth has been the GST, and the GST Council has shown a very fast response. They need to sort of go into this in a very granular fashion and see what are the constraints specifically and what can they do about it quickly. And for oil, most analysts still think that the long run oil price is between 60 and 70, because if it will not sustain for very long above 70, because of the supply response or loss of market share and longer term substitution for non-oil sources of energy.
Okay.
So. And then, Sajid's projections are very linear. They're assuming that what happened in the past will continue. That need not necessarily be the case. And even for fiscal deficit, as I said earlier,
I'll come to fiscal. Ashima, I'll come to fiscal deficit. I'll come to fiscal deficit in a bit.
14, but we did not. Growth continued to be slow because there are sources of demand. When oil prices are high.
Yeah. No,
so
Ashima,
that raises revenues, etc., etc.
No,
so
Ashima,
there are a number of sort of self-correcting features in all markets. Remittances into India rise, which helps the current account adjust somewhat.
Okay.
So as long as we take action, I think there is no need to really panic. And in fact, panic is what creates a tipping point, not the market volatility. You expect some market volatility, but you also expect policy to respond to it.
No,
markets to adjust to some extent.
Ashima, I have to interrupt. My point is, let me not get into fiscal deficit immediately. We'll come to fiscal deficit in a minute. But we have waited for the last, year for this GST supply disruption to subside. But as Sajid points out, for the last 5-6 months, our trade deficit has risen to, $15-16 billion. 1 month, I think, February, even almost $17 billion, 16.5. It doesn't look like exports are firing, although the world is growing. Something's gone seriously broken here. What is your confidence that it will get fixed soon? What is your confidence that we will not get to well over 2.7% in terms of current account deficit?
As I said, there should be some correction. Even oil prices need not continue.
No, but what if
it is? There can be some restrictions based on imports and so on.
If it is?
Policy will not respond if this situation continues. There will be measures taken.
No, what if it remains above $70? It's a very good chance, as several experts say, that it remains between 70 and 75.
But I believe I've heard the finance ministry saying that India, we are comfortable with rates up to 80.
Okay.
Right? In terms of managing the fiscal and the current account deficit, they've done their maths.
Okay.
So it's not really going above that at present.
Okay. Neeraj, are you convinced that there is a likelihood of things getting a little wobbly in the external sector? Right now, we are saved by the fact that the dollar itself is weak. But if for some reason the dollar strengthens, can we have an unnatural adjustment or a quantum leap in the dollar rupee?
So, Lata, if you see the rupee's performance over the last about 4 months or so, essentially since the start of this calendar year, I think if you look at the broad dollar index, we effectively have underperformed by approximately 6% or so. So compared to where we should have been given the dollar trend, dollar has been broadly in a weakening bias. Rupee should have been stronger, but actually net we are weaker by about 3%. Whereas the rest of the world, so on a trade-weighted basis, we are approximately 6% weaker versus some of the other trading partner currencies. Now that's to my mind, the self-correcting feature that Ashima is talking about. At the margin, this kind of underperformance by rupee should actually help exports, even though exports per se may not be that currency sensitive. But at the margin, the 6% underperformance versus some of the major currencies is something which should help. And we should see some benefit of that coming into our, current account numbers going forward. Though the reaction time can be a lot longer than, the volatility in the market. I'm particularly concerned about the news reports that that are talking about that Saudis intend to have the crude oil between $80 to $100. I don't know how much confirmed those news items are, but if that is indeed the case, then we need to be, as Sajid said, that it's not a case for us to panic. It's really, but we need to be vigilant. We need to make sure that the markets are allowed to adjust, the currency adjusts, and that should sort of help in terms of balancing the trade deficit that's sort of accruing over a period of time.
Okay. Well, so therefore, what would you place the current account deficit at? Do you think it goes closer to 3% at all, Neeraj?
Our estimate is that every $10 of increase in crude oil prices adds to about 40 basis points of current account deficit. So we were averaging at 2% of current account deficit at an average oil price of about $67. So from 67 we go to 77 average, we should see about 2.5% current account.
Okay.
Now 2% is a safe zone, 2.5% is somewhat concerning, but still not a panicky zone. Okay. It's somewhat concerning. So I think we can absorb that additional $10, but need to be vigilant.
Okay. Well, my only concern is until now, whenever we had a higher crude price, our destination countries also bought more of Indian exports. But right now, in the current scenario, Indian exports are not firing. That buffer or that counter that we got is not happening this time around. And hence my worry that the same $10 ratio may not work. Well, we have to take a break. The other factor that we are worried about, we've been discussing whether Indian macros have reached a tipping point. The current account deficit shows a danger of going from 2% in FY18 to closer to 2.5% to 3% in the current year, FY19, because of crude prices. But what is the impact it is likely to have on fiscal deficit? We've been speaking with Ashima Goyal, member of the Prime Minister's Economic Advisory Council, Sajid Chinoy, the economist from JP Morgan, and Neeraj Gambhir, the managing director from Nomura. Now for the fiscal deficit. Sajid, what's your estimate? Do you think that the fiscal deficit stops at the budgeted estimate, or do you think it can worsen to probably 3.7 or more, considering the fact that there is an MSP as well as a crude impact?
There's a couple of things. One is, unlike the current account deficit, at some level, the fiscal deficit is a much more direct policy variable. It's under control. And I think given the stress in the bond market, my conviction more and more is that the government is very sensitive to market signals. And I think because it is a variable that you can control, despite the pressures from oil, despite the pressures from MSP, I'm very hopeful that the government will limit the fiscal deficit to 3.3% this year, even if it has to mean some compression of expenditures later this year. Now, one thing that's going to help both the fiscal and the current account is that I think oil price increases should be allowed to be passed on at least, for another $10, $15, because A, it reduces the fiscal pressure, and B, Ashima spoke about some of the natural correctives. This is one of those things. If oil prices go up and pump prices go up, then hopefully volumes will reduce or not grow as fast in response. So I do think, if you think of the current account deficit more fundamentally, it's ultimately nothing but the investment savings gap in India. We want investment to pick up. We hope investment picks up this year. So if investment is picking up and you don't want the current account deficit widen, savings has to pick up in tandem as well, which means public dissaving should not get worse. We've seen state fiscal deficits get worse this year, which is why it's very important that the government stick to its deficit. I increasingly believe they will this year. One last thing I'll say, just as a clarification, our forecast for next year's current account is not a linear projection. As Ashima says, we have built-in exports recovering, but because growth is expected to recover, imports will also grow in tandem. So taking into that account, we end up with a number of 2.7%. Let me just say, no need for panic, Lata. I think the issue is, if policy is prudent, we allow, the GST works on fixing exports, and we allow oil prices to pick up and translate into retail prices, there will be auto-correcting mechanisms both for the fiscal and the current account.
Okay. Well, I'll take your point that policy can always be self-correcting. But Neeraj, the big difference between, say, 2013 and now is that we now have growth on our side, or so it seems. But can that also go for a toss? Given the fact that the NCLT process is not working so fast, and banks are likely to find themselves seriously strapped because of NPA recognition. Even this very good micro growth number that we get, do you think that can get mired or somehow reined in because of, higher prices, because of probably a rupee fall, and the banks being in a broken condition?
So on growth, I think we are fairly optimistic that the estimates that Reserve Bank has put out are achievable. I think if you look at the MPC minutes today, consistently across all MPC members, there is a recognition that there is a pickup in the growth at the micro level. There is a pickup in the credit, offtake in general, despite the situation that the banking system is in, and also the fact that there is a higher capacity utilization. And if you look at some of the micro level data, the high frequency data, you still get the confidence that across the board, growth seems to be in a cyclical recovery path. How long that path sustains is anybody's guess, but at this point in time, it does feel like for the next year, we will be printing the kind of numbers that, in general, the market consensus is. So I'm actually not that worried about growth at this point in time. I also feel that the NCLT process that you talked about is taking its time. I think it was expected that this process will take its time. It's a new process. These are big cases that are expected to be resolved. So some sort of back and forth on these cases, some amount of litigation was to be expected. I'm actually quite heartened by the fact that we had our first resolution, which is the Vitanda's acquisition of Electro-Steel, and we have 3 cases which are likely to go towards liquidation. So to me, out of the 12 cases, you have a clear path on 4 cases within a span of less than a year. I think it's a pretty good outcome. So I'm actually fairly positive on the NCLT process. Yes, there is likely to be going forward more impact on bank balance sheets as the recognition is brought forward, the recognition standards are tightened. But the reality is that incrementally for a lot of banks, the growth is coming from their retail portfolios and not necessarily from their corporate portfolio. So I think that's likely to continue. And the fact of the matter is the credit growth is continuing.
Okay. Well, good to hear that you don't think things have gone bad on the growth front. But Ashiba, a final question to you. I'm not saying that we are in panic mode at all. I'm only asking if macros have reached, all macros have shown deterioration. Once you have a current account deficit that is widening, there is a very good possibility that the dollar becomes a little north of 66. That has its own impact on inflation. Crude could have a direct impact on inflation if the prices are passed on. And then there is a possible MSP impact on inflation. So inflation could be higher than we are now sitting at, growth could be lower than we are now sitting at, fiscal deficit could be higher than what we are now estimating, current account deficit could be higher than what it was in FY18. So is it fair to say that all 4 macros are likely to worsen than what we are now estimating?
Well, these are negative shocks for India, especially oil prices. But, we are in an inflation targeting regime, and the Reserve Bank will respond quickly. And it is true that once you have inflation targeting, these sort of cost shocks need not necessarily show up in inflation.
Okay.
Yes. To that extent, to the extent inflation expectations are anchored. And 2 other points I would like to make is that our growth is largely driven by domestic consumption.
Yes.
Exports are net negative for demand, right?
Yes.
So our export is robust to that extent to global shocks. The second point is about MSP. There's a widespread fear that this will be inflationary, but actually it is arising out of a problem of plenty. Prices have crashed below variable costs for farmers. Now, if you give them variable costs, not the comprehensive cost, that is not inflationary. And the need to increase farmers' income should come from other types of rural activity. There's a large growth in horticulture and other kind of changes taking place. Non-rural farm employment is increasing. So it should not be taken to mean that prices are going to be raised to really raise their incomes. Prices are only going to give them a minimum variable cost. And therefore, and for the major crops, this is actually ruling below market prices at present. So it's not necessary that MSP will really add to inflationary pressures. And there is a general fear in India that because we went through an episode since 2007 of really high food prices triggering inflation, that second round effect takes place. But that second round effect takes place only if food inflation is sustained and it's above 10%, which happened in that case. It's not going to happen now. You know, one feature of robust markets, and India has strengthened its institutions and markets, is that volatility is reduced. You need not see very large spikes. A market by itself can create large spikes, but then regulation comes in. So if you have good regulation and good markets, some volatility is healthy for hedging and for markets to work well. So we should not be afraid of volatility. Allow some volatility and allow markets to self-correct, as well as prevent overshooting. Regulators should prevent overshooting. Then I think we are fine. We are just learning to navigate the international ocean, which is a bit choppy. We should go ahead and enjoy the ride, even if it's a bit up and down.
Well, that's as far as markets are concerned. But I am reassured that none of my star panel members are expecting that current account deficit or fiscal deficit will get out of hand. They may get a little worse than what we are budgeting for, but it's not going to be in panic mode as well. They're mostly reassured on growth. Fine, growth can paper over a lot of deficits, but let's hope that growth does not get stymied by either the current account deficit or the fiscal deficit, or both of them getting a little out of whack. Ashima Goyal, Sajid Chenoy and Neeraj Gambhir, thank you very much for joining me in this conversation.